Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to my weekly show here on StockCharts TV. Today we're going to talk about 3 concerning breakdowns. I think we're in a topping process from the major market averages, the S&P 500 and the NASDAQ. We've been covering that very closely on our market recap show called Chart This with Dave Keller, which runs every weekday after the close on my YouTube channel called Market Misbehavior. We also have a great podcast called the Market Misbehavior Podcast, where we interview some great market practitioners. Had some really good interviews recently talking about signs of concern, talking about potential strategies to use, defensive option strategies, and many other things, given some market instability. But today we're going to talk about 3 charts in particular that I think really demonstrate a what we call a change of character in the markets. Right, there are leading indicators that often happen going into a major market top. Things like the Hindenburg Omen are a great example of that. They combine measures of momentum and measures of breadth. They look for signs that momentum is slowing. They look for signs that breadth conditions are deteriorating. I would say all of which we've observed since the end of June in some fashion. Now what we look for is signs of rotation, signs that investors are rotating away from risk on to risk off positioning. The 3 charts we're going to share with you today, I think, tell that story in a couple different ways, but it's very intriguing that all of them are breaking down here in mid-November 2025. We'll finish with the chart of the S&P 500, but first let's get to these 3 breakdowns. First off, we're going to talk about what I call the newer Dow Theory. Charles Dow, back in the early 20th century, really laid the foundation for technical analysis and market analysis as we know it by looking at different ways of gauging the strength of the economy using equity indexes, right? The Dow Industrials and the Dow Transports. And actually, in his day, it was the Dow Railroad. So it was the industrials, the producers of goods, and the railroad companies, the distributors of goods. And the idea was if both of those groups of companies were doing well, if both of those indexes were breaking out, that was a bullish confirmed signal because the economy was doing well. If both of those indexes, the producers and the distributors, were breaking down, that was bearish because we're seeing weakness in both cases. If there's a divergence, if one breaks out and the other does not, that's called a bearish non-confirmation. That would be a sign of internal weakness as well. I would argue what we're observing here in November is a breakdown, what we call a bearish confirmed signal from Dow Theory. Now, in this case, I'm not using Charles Dow's original indexes. I'm using a modern version that I think better represents Charles Dow's, sort of the essence of his approach, but updated for the current market environment. What we're doing here is we're looking at the equal weighted S&P 500 in the top half. And instead of using an index, I'm using the ETF, the RSP, which is the Invesco S&P Equal Weight ETF. That's this series at the top. The bottom half is the equal weighted NASDAQ 100. So we sort of have the old economy in the top panel, the new economy in the bottom panel. Again, it's a way of just summarizing it. Why are we using equal weighted indexes? The problem is those mega cap growth stocks are such a huge weight in the S&P 500 and the NASDAQ that if we look at the regular cap weighted versions, they look very similar because they're both driven by the same leading growth names. By looking at the equal weighted indexes, we can better look at the performance of the group of stocks as a whole and not just focus on the magnificent 7 names because of their significant weight in those benchmarks. So we can see that both of these indexes made a new 52-week high in early October. We can see both of them made a new 52-week high in late October. Both of them made a lower peak earlier this month in November, but now just this week, we've seen a concerning breakdown with the equal-weighted S&P 500 undercutting its October low and the equal-weighted NASDAQ undercutting its October low as well. Assuming we get downside follow-through through the remainder of this week, that would imply a bearish confirmed configuration from newer Dow Theory. We haven't had one of these patterns where both of them are breaking new swing lows really since February, right? That was the last time when you had a real breakdown. We actually had a big non-confirmation in February, with the equal-weighted NASDAQ making a new high and the equal-weighted S&P not doing so. But it looks like finally in March, you had both of those break below their January lows, and that indicated a period of weakness. Since then, we've actually seen higher lows pretty consistently across these 2 indexes. In August and September, I put these lines here thinking, all right, the equal-weighted NASDAQ very close to breaking down. Let's monitor this. We never got it. Both of them eventually made a new high. sort of continuing a bullish confirmed pattern, which continued through late October. So chart number one, this is what I call the newer Dow Theory. Both of these indexes now breaking down in the same week. That implies, based on Charles Dow's foundational work from over 120 years ago, we're in a period of distribution for the economy. Chart number two is a chart I just call offense versus defense. This is looking at the consumer discretionary sector versus the consumer staple sector. And I love this ratio because it really captures the essence of investors rotating around sectors. The numerator in these ratios, consumer discretionary, that's things you want. The denominator, consumer staples, these are things you need. What does that mean? When things are good, when consumers have money to spend, when they're optimistic, when they're willing to spend money, you spend it on discretionary purchases, luxury things like travel, tourism, hotels, gambling, new cars, new clothes, new watches. These are all things that are discretionary purchases. You don't need them to survive, but a lot of people think they make their life a little more interesting or a little more glistening, I guess. When conditions are good, you tend to be able to spend more money on those things. When things get tight, you opt not to make discretionary purchases because you don't need them. The denominator, consumer staples, are more consistent. They're a little more immune to economic shifts because you kind of always need cleaning products. You kind of always need toilet paper and, household goods. You kind of always need beverages and tobacco and food products, right? You don't usually upgrade those things when conditions are good. These are just, you kind of have your normal routines, you just kind of spend on those things. So by looking at this ratio, we can understand if investors are getting more optimistic, focusing on things you want, expecting consumers to have more money to spend, versus things you need. When consumers would get a little more risk off, they would not be spending on those discretionary purchases. These ratios should go lower. So we can see going into the end of September, both of these actually made a new high for 2025, both eclipsing their peaks from Q1. From there, we actually pulled back, and in early October, we highlighted the fact that both of these had rotated higher. Remember that idea of a non-confirmation we talked about on chart number one? We did actually get a bit of a non-confirmation here with the cap-weighted version making a new high at the end of October, but the equal-weighted version, which is at the bottom, not making a new high. So why did these disagree? Because if you look back, these lines tend to move together. They tend to have very similar patterns, but occasionally there will be some divergences. So what would cause this divergence with the cap-weighted version going up and the equal-weighted version going down? What you have to remember is the XLY has a couple huge names, Amazon and Tesla. Home Depot is third in that ETF. So both Amazon and Tesla did quite well in the second half of October. And because those two names did so well, the XLY, which is a cap-weighted ETF or an ETF based on a cap-weighted index, that really caused the numerator to accelerate and cause this XLY to XLP ratio make a new high. But the equal-weighted version, which kind of takes away that overweight on Amazon and Tesla, did not. So this tells you it was really just a couple stocks that were doing quite well, most likely, and that the general trend was away from risk on and into more of a risk off positioning. I would argue that's most likely been confirmed here this week because both the cap weighted and equal weighted versions have now broken below their October low. The cap weighted version here is just slightly undercutting it. It's not, we'll see if there's confirmation below, but the equal weighted version for me is a much better representation of a general rotation between offense and defense. And as you can see here, we're actually undercutting it and making a new, almost a new 3-month low here this week. So chart number two, concerning breakdown, offense over defense. Now in the month of November, very much shifting from favoring offense to favoring defense. This implies that big investors are leaning more on the defensive side of the ledger. That's not a great sign for stocks. Here's the final chart. This is the first one that's not a ratio. We had the Dow Theory looking at the S&P and the NASDAQ. We had offense versus defense looking at two of the consumer sectors. Here we're actually just looking at Bitcoin. I think Bitcoin is a fantastic chart to analyze, mainly because there's just not a lot of fundamental data. Excuse me. If you think about a stock, if you think about an equity index, there's a lot of sort of macro influences that can impact them. There's certainly a lot of company-specific risk like earnings and volatility and things like that. But with cryptocurrencies, there's just not a lot of fundamental data to go through. There is a limited amount, right? You can look at mining statistics, you can look at accounts opened and things like that. You can look at holdings and get a sense of what the whales are doing. But in general, this is a kind of a petri dish for speculative pressures, right? The chart of Bitcoin, I would argue, is largely driven by optimism or pessimism. It's driven by fear of missing out, which drives the uptrend phases, fear of losing everything, which does the downtrend phases. So let's look at the chart and see what's actually happened, because the price of Bitcoin has certainly deteriorated here in the fourth quarter. At the end of the third quarter, right, at the end of September, we had experienced a breakout to a new high, right? We'd eclipsed the highs from the end of 2024, beginning of 2025. We'd consolidated around that range in Q2, and then Q3 starts. In July, we see a push above $123. I would argue that the peak in August and then the peak in October were essentially retests of that July peak. And basically, we have sort of a triple top formation, right? A level that's reached, a level that's retested, a level that's retested once again, and we just weren't able to gain any foothold above that kind of 123 to 125 level. From there, we pulled back and yet again tested this range. This is a range that we've had on the chart for quite some time, right? Going back to the December and January highs, it seemed like that was an important level to, an important range to watch. You can see that support in August and September and October all sort of ended right in that shaded area. We also hit the 200-day moving average in October, and as Q4 has progressed, we've broken below the 50-day moving average and tested it a couple times, unable to regain it. We broke below the 200-day moving average, didn't even get a decent retest of that moving average, but we did retest this shaded area. So as what often happens in the technical analysis world, resistance becomes support, and in this case, support becomes resistance. So that breakdown happens in early November. We rally up and stall out right in that support zone, and then we rotate lower. We can also look at some of the Fibonacci levels. So if we take the April low up to the July peak, 38.2% of the way down is around 104,000. That's where we ended there in October, which means that breakdown below 104, the retest also was a breakdown and retest of a key Fibonacci support level. From there, my initial downside target was around 92, 93,000. That was based on this Fibonacci retracement. We take the April low to the July peak, 61.8% of the way down is around 93,000. As you can see, this week, we've actually broken down through that level. It's the first time we've been below that point since back in April, since back here. So what's next? So what concerns me about this chart is after we break below 93,000, there just isn't a lot of support on the chart until we get back to the February, March, April lows. That would imply a downside trajectory to around 75 to 80,000, right? Which would be sort of these lows right here. If you sort of think of that as a new shaded area, that could be the next downside objective for Bitcoin, given the fact that support has not held. The other thing, and this is a great StockCharts trick, Grayson Rose always reminds me about this. You have this inspect tool just above the chart. So if we click on that, you can left click and drag, and on the far left side of the chart, we can see the percent drop from where I started to where I finished. So from the December 2024 peak to the April 2025 low, that's a 31.5% drop. If we assume a similar drop, 31.5%, that would get us down not too far below current levels, right? That would put us down around 87,000. If we take it off of the July low, that would be, oh boy, I already forget the number. 31 and a half. So if we take 31.5% off of that high. Right, so that takes us down into around 85, 87,000, which is basically not too far below current levels. Now, that would just assume that this drop that we've experienced, would be about the same as the drop that we experienced from January to April of this year. I don't think that's reasonable to expect that this is going to look exactly like that. What I would say is it's less about having a similar move, and it's more about what we saw after April that confirmed to us that the April 2025 low was a meaningful one and that Bitcoin was starting to improve again. Here's where I think it's important to look at the RSI at the bottom. If we look at the relative strength index here, we can see in the fourth quarter of 2024 going into that December peak, the RSI consistently overbought on rallies, never really gets below the 40 level on pullbacks. Look at how that changed in February as we break down below an RSI of 40, and the RSI doesn't get much above 50 all through March and into April. End of April, once we finally bounced off of the low, the RSI finally pushes above 60. The price of Bitcoin finally gets back above the 200-day moving average. For me, that was the all clear sign that the April low was a meaningful one and that it was reasonable to expect much further upside and a resumption of the uptrend phase, right? So the RSI and just the shift in the range was pretty meaningful. Now, since then, we've seen the RSI consistently in a bullish range. We become overbought on these rallies. The RSI doesn't get much below 40 on pullbacks. That's really started to change in the month of November as we've sold off, and now we're oversold for the first time since late February. So getting into that oversold condition, while it may indicate a short-term bounce, I think it more is a sign of negative momentum, more of a distribution phase, suggesting that the momentum is generally weaker. So the all clear for me, would be some combination of the RSI pushing above 60, price making a higher low, price getting above the 200-day moving average, at least price getting above key resistance levels above the current price action. And I would say initially, watching that 61.8% level could be a really good initial sign that there's an upside rotation. So that would mean, right, at some point we find some stability, waiting for that breakout above previous support, looking for the improving momentum could be a sign of a further accumulation. But for now, Bitcoin's breaking down. Now, what does this mean relative to the first two charts we talked about? This is a great sign of speculation. When people are all bullish and they're all looking for things going up to put their money in, they buy Bitcoin, and that's what causes the price to go up. When investors get really nervous, when people that are in the Bitcoin space are getting nervous about further downside, they start unwinding positions, they start selling, and that's causing the price to trend lower. So I would argue the breakdown in Bitcoin, which really happened before the equity markets, had their October, November top. I think the breakdown in Bitcoin for now appears to be a great leading indicator of a risk-off sort of sentiment here in Q4. And from the beginning of October, Bitcoin has been generally trending lower. Now we're seeing other more equity-based ratios like Dow Theory and offense versus defense signaling weakness as well. So those are the three charts that have broken down, three charts that I think represent a real rotation from risk on to risk off. The most important breakdown to watch for, though, however, is the S&P 500. And that's where we have not yet broken our line in the sand. So those first three, those are the three breakdowns I've observed. The most meaningful breakdown that for me would indicate a real negative a risk-off scenario for the S&P would be a break below 65.50. When you think about the basic structure of these markets off the April 2025 low, from that point on, we have had a very consistent pattern of higher highs and higher lows. When the S&P has surged higher, it's eclipsed its previous swing high. When it's pulled back, we have not undercut the previous low. That happened in June. That happened in July, August, September, October. Every one of these pullbacks, we've remained above the previous low. So as we've gone higher, I've continued to add new support levels. This is the new line in the sand that keeps getting upgraded as we go higher. I would say for now, those lows from September and October, which is around 65.50, that's the line in the sand to watch. And if the S&P can hold that, despite those breakdowns that we observed on some of those other charts, conditions are still okay. However, if the S&P would break its line in the sand at 65.50, that is one of the key bullet points on my market top checklist, one of the lagging indicators that would confirm that whatever concerning signs we were seeing earlier in previous months are now starting to manifest themselves with a risk-off move in the major averages. So S&P below 65.50, I have an alert set. I would encourage you to do the same. By the way, if you don't use the alerts on StockCharts, you are missing one of the great ways that a platform like StockCharts can make your life a little easier. Below any of the charts that you have, you click on the little bell. It'll automatically import the ticker you're using, and it will also import the current price. You say above or below. You say 65.50. You put a message in there, breaking the line in the sand. I like to select all of these, which means StockCharts sends me an email with an update on what's happened. I have a folder set up in my Gmail account, so all of those alerts go in one place so I can review them later, all time-stamped and date-stamped. Text message, so my phone lights up with that breakdown. Site notification, which means there's a banner on the top of the StockCharts website. So it is very hard to miss these alerts if you set them up correctly. So I would encourage you, the next time you're looking at a chart, you see a meaningful level, you come up with that line in the sand that would tell you to take some sort of action. Don't forget to click the bell below the chart, enter the limit, and there's also an advanced alert you can select from that menu as well if you want to get more particular and screen on moving averages or something crazier. But for me, I usually keep it to just price levels, lines in the sand, and this is the chart of the S&P is one where I think that certainly makes a lot of sense. What do you think about these breakdowns? Are there other charts that have caused you to be a little more concerned? Is there a chart that makes you feel like this is not that big of a deal and it's yet another Bible dip? Make sure you drop a comment below and let me know. I'm always looking for new charts to incorporate into my own process. I hope this discussion helped you out today. As a reminder, our market recap show called Chart This with Dave Keller runs every weekday after the trading day closes on my YouTube channel called Market Misbehavior. And if you head over there, you will also find the latest episodes of the Market Misbehavior podcast. I've interviewed people like Andrew Thrasher, many others, with some really good insights about how to understand what's happening in the markets, what tools and techniques they use, how to use other asset classes like options and other things to hedge positions and take defensive positioning. I hope reviewing those podcast interviews give you some ideas of how to upgrade your own process. For now, I will say thank you so much for joining me here on StockCharts TV. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.